Hey guys, welcome to the second episode of Finance Musings with yours truly, Sajin Doshi. Today, if you guys remember, I'm going to be finishing up a conversation that we started last week about Berry Global, a company that, again, still full disclosure, do not own any shares in the company, but started that conversation about what I liked about the business. And a quick recap, we talked about kind of what they do, who their customers are, what their business model is, who their customers are, their end users, their clients, etc. And this part, the second part of the podcast, I wanted to dive into more of some of their financial figures, more about some of the negatives of the company. I know I've been singing their praises, so it's like, hey, let's give some, hey, what are some negatives of the business? And then kind of diving a little bit deeper into the investment case itself, right? So let's get right into it. So and again, I think future episodes I might start off with some of this stuff to help preface the analysis, and that way people can kind of have a more objective take on it before I kind of dive into kind of the moats, the strengths, weaknesses, and before kind of going into the investment case. High level, just some financials. Fiscal year 2020, about 12 billion in revenue. I mean, 11.7. I'm just going to be rounding up. Like I said in the earlier part, they had about 1.2 billion in EBIT or operating income. Their interest expense, about $400 million of interest expense. So that gets you down to what, 550 550 million in NOPAT, or net income, or net operating profit after taxes. Let's just go with net income and not get too fancy. And the thing that I touched on was, again, about, hey, this valuation disconnect that exists. Management has been very clear that, hey, we are using all of our free cash flow to pay down debt, and the roughly $1 billion that they generated, they use it all to pay down debt, right? And two things to that is, one is that, hey, what happens to free cash flow after post-debt pay down? Is it used to fund further acquisitions? Is it used to go after more investments in capex into growth and expanding the footprint? Or does it go towards a dividend or a buyback? It's something that has been asked numerous times on earnings calls, to which we have not gotten a clear answer. But again, I think most likely there will be a share buyback for a plethora of reasons. That share buybacks versus dividend, we can get into that in another episode. But in my opinion, I feel like there will most likely be a buyback. They might do some smaller acquisitions. They're going to continue to obviously drive capex to kind of align themselves with what customer needs are. Because if you remember in the last episode, I talked about how I feel like, and I actually haven't done this analysis. I've obviously scrubbed EBITDA and kind of done some valuation work, but analysis that I'm trying to figure out to do, it's just tough because you're not going to report all of this, but it's to see the dollar for dollar match of capex and what the ROI has been. And it is obviously very clear, dollar for dollar. And then eventually, once those fixed costs are met, again, guys, operating leverage, that anything above those fixed costs, will drop down, and it will be pure profit, right? So pivoting past that, something that I touched on in the last part of the episode, and even management themselves will say this, is that there is a lot of room for growth, because the cash flows of the company, frankly, oh wow, I just almost knocked this ridiculously expensive Shure mic over. That would not have been pretty. But the free cash flows are not being valued fairly, right? Even if you look at a conservative multiple range, and this is just me arbitrarily pulling something out of the air of saying 10 to 15 times EBITDA, right? And again, relative to what, right? If you're looking for value where there is runway for growth and substantial growth, where once the market sees that, hey, the balance sheet has been delevered, this is a company with a lot of free cash flow, they're not being valued at a multiple that would be seen as expensive relative to other companies, and their free cash flow yields are better than their competitors. And again, if you're looking at a free cash flow yield, look at an enterprise value versus market cap to truly understand the effects of, like, hey, what is the impact of net debt? What is their cash balance? You get a truer yield when you look at a bigger picture. Excuse me, guys. I'm just gonna take a quick sip of water. Shout out to the sponsor that I don't have yet, my water sponsor, that I'm clearly trying to find one. I'm waiting for the day that I do get a water bottle sponsor. I'm really curious to know who that is. But going back to their cash flows not being valued properly in my lack of sponsorship problems. But so right now, their free cash flow, like I said, they're yielding about 10%. If you look at some of their peers that are not yielding that much, they're being valued at a 10 to 15x EBITDA versus Berry's at like a 7x multiple, right? So it's like, the leverage is really impacting the company a lot. Again, going to transition very nicely into, hey, what are some of the negatives for the business over the next 12 months, long term, maybe over the next 5 years? And maybe, hey, Sajin, people might say objectively, maybe it's more than, a leverage issue that's holding the business back. And when I think about this, yes, there is an argument to be made about, hey, if there's an increase in resin prices or a shortage of available resin, what would be the impact on the financial operations and the whole supply chain and disruption? But what we have to understand is that this is overblown to an extent, as we've seen in this COVID environment, is that, hey, as these input costs are increasing, are their margins expanding or are their margins shrinking, right? That's something that we need to be accounted for, right? And there is a lag of these cost inflations getting passed on to the customers. This is something that sometimes I question why people ask the same question ad nauseum to management when it's like, well, they're passing cost on. What company does not pass costs, through to their customer? Like, there is a timing lag. It is how accounting, it's just, it's how it works, right? It's not like prices go up one day, you're going to pass it on the next day. There is a timing lag, and it's vice versa, right? If price movements move in favor of Berry, that realization won't happen on the financial statements for maybe another quarter or a month, 2 or 3, right? So it's just, again, that ebb and flow can go up or down, but that impact won't be realized for a few months thereafter, right? So it's something that you think at this point, if you've been covering the company for years, like, you should know that, and you should take that into account to your valuation of, like, hey, we know there's this cost inflation happening. We predict it'll flow through at this rate, so we'll probably see a bump in guidance on a per share basis of like 10 cents, in a quarter, at the latest. I don't know, right? It's something that, like, it's overblown in my opinion. So that's what I'll say on that. In terms of, again, touching on the input cost that goes into making some of the plastics, right? If you look at natural gas, crude oil, from what resins are actually produced, yes, now that is a bit of a risk of, like, hey, what happens if, like, that supply completely stops? On the flip side, Berry is not dependent on a single supplier. They have a plethora of supplier. I don't think a single supplier makes it more than 10-15% of their capacity. So the benefit of having a global footprint, global operations, right, and scale at that level is that, hey, you have suppliers who are getting their end inputs from a variety of natural gas, crude oil, and producers themselves. So you're not necessarily dependent. It's not like you're getting all of your natural gas and crude oil from one country that's producing it so you can make your plastic, your resins, and then that's the one supplier you use, right? They're pretty well diversified in terms of where they're getting their resins from, right? So I'm gonna leave that for, I think that's another concern that maybe people are looking into a little too much. And then the mitigation I said about the passing inflation costs, they're doing that. It just happens. The other thing is, if you look in their queue, and I know I'm like snickering now, so people are like, oh, hey, this is the bad news right here. So I'm just in their queue right now, and I'm just searching debt cost because I just want to confirm. Okay, variable rate interest. So what I'm doing right now, for people who can't see, I'm looking in their queue, and so in 2021 they raised senior secured debt and about $1 billion. I'm just trying to find their give me 1 second, folks. Variable. It is coming. So essentially, okay, this is the. So look, if you go to their queue, So if you go to their queue and if you go to the queue for July 2021 and you go to page 12, so right here, this is again their substantial indebtedness, as they say, but it's like, again, I worked in restructuring, so substantial indebtedness to me is like 20x leverage, not 3x or 4x, right? And maybe that's why I'm a little skewed in that thinking because it's like you have the cash flow to cover interest. You're paying down debt. Stop painting. It's interesting as management. Why are you painting that story? It's like literally come out and say, hey, we're pumping out $1 billion in cash flow. We are going to hit our 3x leverage mark in a few quarters. We are getting there, right? The world is not ending. But go to page 12. So during fiscal 2021, the company issued various fixed rate first priority senior secured notes and used the proceeds to pay a portion of its variable rate term loans. As a result, the company de-designated $1 billion interest rate swap transaction that was set to expire in June 2026. Blah, blah, blah. And then you go to, as of July 3rd, 2021, the company effectively had a $400 million interest rate swap transaction that swaps a 1-month variable LIBOR contract for a fixed annual rate. And then the second part, again, this was the $400 million interest rate swap that swaps 1-month variable LIBOR for a fixed amount. So essentially, they swapped out all their variable rate. I just want to confirm it was all of it. And this is what I was looking for because this was a little nuance that they didn't cover in detail. Oh, a little too close to the mic. But all that to say is that all their debt that was variable in nature, that you make the estimation that like, hey, if you're tied to LIBOR in an environment where as of right now in fall 2021, interest rates going up, we don't, what is going to happen with interest rates? That if you have $1 billion in debt, even a even a quarter interest increase will lead to a substantial amount in interest expense, right? I mean, just do the math on that, right? 0.25 times $1 billion, right? Or that, on that specific portion of that debt, that's what, 5, 10, $15 million, $20 million just by a change in LIBOR. So, from what I can tell, all their variable, those interest rates haven't swapped out for fixed rates. So again, you can have the substantial indebtedness, but now you have mitigated a way of like, hey, can a rate change really come back and bite us in our butt, right? So again, that is another thing that they have kind of not explained away, they've actually done away, right? So, sorry, my phone is blowing up. My lovely girlfriend is texting me in the middle of a recording. Come on, who does that? Get it together. But no, going back to the investment case and kind of why I'm so strong and bull Barry is, and I'll close it out with this guy, right? So like getting ready, rolling my sleeves up. It's like, all right, Taj, like what's the verdict, right? So one, I already gonna kind of run through these bullet list style, right? So one, Barry, I already said trading at a discount to their peers, and where it has traded historically, right? They have the scale where they can expand margins, right? Because they have their fixed costs are very controllable. Variable costs, which again, plastic resins make up about 50% of their cost of goods sold. And again, as you are able to lower your manufacturing costs, and again, as the large billions of pounds of resins that you're buying, you're going to get price concessions from these producers, right? So this is significant because, and I wish I was doing my screen recording, and I might do that in the next episodes. I could kind of draw out some math and people can see. But for example, if your COGS base is, let's say your COGS are $10, right? And 50% of that is resin. And so that's $5 of that input into your COGS is resin. And the other 5 is whatever. So you have 10 in total. 5 is your resin. Now, because of the price concessions that you're able to get, that bumps down to, let's say, 3 or 4, right? So now that percentage, the proportion of your total COGS, that proportion might be there, but your overall COGS costs have now decreased, right? Because of the concessions and the power that the company has because they're such a large buyer of plastic resin, right? So again, that's something that is not being taken into account is that, hey, as the company scales, there is top line ability for them to expand their margins before you get below the line, right? The other thing is this whole talk about leverage keeping people off and not being interested. Listen, they're paying down their debt. I think investors will recognize this. And they will then see like, hey, these are margins that can be kept. There's a global footprint, there's scale, there's stickiness to the revenue. The investing and capital allocations that make are in lockstep with clients, right? And as they continue to do this, this is going to drive more scale, lowering costs, because now you have to remember one factory can produce everything across all 3 segments. So now those costs are being spread out. Wow. The other big thing, again, I talked about this in the first part, was the ability to tackle the future. And when that eco revolution happens with plastic and eco-friendly packaging, government regulations, etc., that comes in, Berry Global's already positioned. So who do you think is going to be driving that change, right? It's going to be incumbents, in my opinion, who will be able to lead that, because they have R&D, they have the material scientists, they have the engineers who can already make packaging better and more environmentally friendly. So when push comes to shove and that comes to the forefront, Barry's already going to be doing that, right? Sorry, I keep literally I'm abusing my mic right now. So the other thing was, again, this is really, really important. Operating leverage. I cannot stress to this. Again, as the growth happens, right, and their costs are controllable, right? I'll give it a simpler example of Microsoft, right? Because it's more simpler to understand, is that a company like Microsoft, your costs go in to build the software. Once those costs are met, right, you sell enough and you break even. Anything that you make in addition to that software being sold, your costs were covered, because that's just a reusable license, right? Unless you go and develop another software, Windows 30 or whatever the case is, right? So again, the same concept and the idea of high operating leverage, low operating leverage, and understanding where Barry fits within that is very, very important. And I might just do an episode of taking 4 companies and showing different operating leverage, different capital structures, so that you can actually see numerator, denominator, and you can see if this numerator changes, denominator stays the same, or vice versa. What does that do to operating leverage, and what does that mean for the company? Because I still think if you're in college, or you're not going to be learning this unless you're actually in a really rigorous finance program. It's hey, let's look at these 2 companies. Let's look at their cap structure. Let's break it out and let's see what impacts, above the line, below the line, price expansion, cost reduction, multiple expansion. What does that all do, and how's that all interlaced? I might just do a video on that, because I think that'll be helpful, especially when you see numbers and you actually kind of see the math. It'll make it better. But again, going back to Barry, I was going to say Jerry, but going back to Barry again, as these improvements happen, you're going to have better than expected operating leverage. The next thing is that HHS, Health Hygiene Specialties, they talk about this a lot in their earnings, about how this is a very higher margin product. So again, think of adult, the adult diapers is one. There's a lot of feminine products, so tampons, pads. There's a lot of, especially now, as we transition into COVID, there is a lot more into, that's getting put into HHS. And again, that is a segment that is growing very rapidly as the company's expanding into higher margin products. So again, I think people are choosing to look to the negatives versus saying hey, let's look at the negatives and understand that, hey, the business has certain things to be mindful of, but are they mitigating them? Are they doing what they can? And what are the positives for the company? And I might even have to do a part 3. There's let me see if I could run through this, right? Debt reduction, right? What happens when, at a theoretical level, and again, I feel like I'm going to do a lot of videos to preface this, so people, when I kind of give these terms out, what happens when you deleverage, right? This high leverage is driving this inefficiency that people look at how much debt Barry's holding, and they're you know what? Is there a clear path to deleveraging? Management has clearly laid out a path of, hey, if we reduce leverage from 4x to 3x by fiscal year 2022, there is a path. This is how our cash flows are going. And what happens is that debt reduction is only going to create value for the equity holders, right? As that interest expense decreases, right? That is that net debt impact. What does that do to enterprise value? What does that do to multiples, right? So again, as you continue to deleverage the business, I was going to say the business. God, maybe I do need a break. It is getting a little hot in my room. But as you continue to deleverage the business, right, you continue to pay down debt, that value goes to equity holders. That reduction in net debt is what drives value to equity holders, and thereby increases potential investors who are interested in buying the company. You see this increase in its multiple, right? So that is how paying down debt will help Berry because, like I said, they've historically traded between 8x turn on EBITDA when they've been at a higher leverage, and right now they're at a 7x. Right, and if you look at their peers are trading at much higher multiples, due in part to having a lowered capital structure. And like I said, that lower capital structure is what's allowing, I believe, if you look at an Amcor is being valued at the market at what? I should have this pulled up. Maybe 5x EBITDA premium, in relation to what Berry's trading at, right? So again, for me, if you look at their investor presentation and you look at their and you look at their Q, read their earnings transcript, like the investment that the company's actually doing into the business, right? The increase in capex is focused on not only growing their portfolio. Hey, how can we grow the portfolio to build out our business and our supply chain so that our customers can better serve their end markets, right? Again, that's just an overarching theme, right? Then the other part is, hey, how can we increase our presence in emerging markets? So you think Asia ASPAC, so Asia, Pacific, South America, Mexico, Africa, Eastern Europe, etc. And they just opened a factory in Bangalore, I believe, for more health, hygiene focused products. But again, that factory will be retrofitted to be able to be cross-functional and serve other clients who might be in India or might be in Bangalore, right? So that's the example I gave of like Starbucks, right? There could very well be like a biscuit company that needs plastic packaging for their biscuits, right? And they might have a processing facility in India. Now, they don't want to get their packaging from Berry's footprints, their facilities in America. Well, it's like, hey, guess what? We have a factory in Bangalore that can also do this for you as well. Again, I'm pretty sure that this particular factory is more related to separate health-focused hygiene products. But again, the idea stands that these factories can be retrofitted, right? So again, think on that. So again, in conclusion, before I kind of dive into the earnings calls, which I'm kind of excited about, my thoughts are that, yes, again, relative to where other companies across industries and sectors, so growth, small cap, large cap, it's all about trying to find value where value doesn't exist, and if value is not being appreciated, and where is there a runway for growth that is going to be captured, and then that growth is going to be reciprocated and appreciated by the market, right? So again, listen on your own through the earnings calls. If I had to give homework out, right, like I do in my other podcast, listen to the past two earnings calls, go through the Q, the K, read the investor presentation. And again, the story is simple. Plastic manufacturing, it is a business that needs to be here, a wide variety of end uses, wide variety of end customers. They're not dependent on suppliers. They're not constrained by having to stick to pricing issues or pricing constraints, right? They have leeway. They have power, right? Not only to the customers, but also with their suppliers because they're a big player in the game. They generate a ton of cash flow. They're paying down debt aggressively. And as debt gets paid down, that accrues value for equity holders. And then what they decide to do with that free cash flow, who knows what they do, right? And I do believe that there will be a buyback, probably in 2023, right? And it could be substantial. And you start building that position now. Again, who knows, right? I could be wrong. They could not do it. They might do another acquisition. Their street might react negatively. I don't know. But I do believe that there will be some sort of a buyback, in my opinion. So, wow, that was a lot, guys. That is Berry Global in a nutshell. I'm going to go and quickly speak to some of the earnings call highlights that I thought were really, really interesting. There was one question about the CEO and the CFO. They talked about investing into long-term fundamentals, right? So mega trends. This is exactly what we're talking about. This is literally word for word what the CFO said. Long-term fundamentals that we've invested in around mega trends like health and wellness, e-commerce, food safety, coupled together, etc., have now been over 1.5 billion of our revenue base. So again, each of the businesses we've continued to invest organically alongside our customers. So this is what's beautiful, right? That these are consistent low single-digit growth opportunities alongside their customers. This is literally from the mouth of the management team. And this is what I'm stressing, is that their capital outlays are strategically aligned with their customers, right? Who are like, hey, we need to make more, where we're going to be producing more health and wellness products, food safety, e-commerce. Hey, Berry, come with us and build a factory here because we're going to want to build out our business in this part of the world, right? That's really important too. So this is actually a great Great question too. One of the analysts outright was like, "Hey, do you think greater than $1 billion in free cash flow still feels like a reasonable target?" And CFO straight up literally said, he was like, "Hey, look, I think that you know if we don't have this negative impact on working capital, we think we can get to this, and this is a big one for us for next year." Literally, again, that is as guidance as get. It's like, hey, you're going to get more than $1 billion in free cash flow. That free cash flow, they're going to delever down to 3x way faster than end of 2022. That's a year and a half out. I don't know why. Again, maybe they have some investments that they haven't publicly spoken to, but they are definitely going to hit that target. Second thing, this was huge. This was really, really huge. About one of the questions was like, hey, growth and investments that you've been making and the amount of investment you've made in HHS, like I talked about, it's such a high margin products that are being made. Look at what they said. The question was like, hey, what does that investment mean for revenue growth for that segment? And is that something that might be constant over the years? And this is an important question to think about, because what did I talk about? It's that dollar for dollar capex, capital investment allocation into the ROI that you should see. And when does it become 2x, 3x, 4x? And again, is that constant, or how soon should we expect it? This was literally verbatim for management. We continue to pivot more of that portfolio to areas with faster growth in geographies that are faster growing. So hygiene and healthcare continue to be areas of importance inside of HHS. We have increased our presence around adult incontinence, premium hygiene, feminine care. Literally the three things that I also just said, right? Those are high margin products. These are growing in emerging markets. So you think in sub-Saharan Africa, certain Asia ASPAC countries, certain Eastern European countries. And then the CFO chimed in again and said, he was like, hey, look, this is great. This is, if you listen to this 40-minute podcast, 20-minute or 30 minutes, the metrics we have provided in the past, although they can swing around with resin a little bit, right, in terms of top line dollars, but the dollar for dollar, I think is still a good general rule of thumb, that dollar of revenue for every dollar of capex on growth. And those are 20-ish IRRs on EBITDA margins, which means in this case is that given that it's dollar for dollar, it's going to hold true for our portfolio. And I don't want to comment on the individual segments, but I think in the aggregate, that still holds true and would also hold true for the HHS category. So there is multiple assets that are being invested in total. About half of our $700 million of capital is related to growth. So call it $350 million-ish of capex this year that we would expect to drive both top line and bottom line as we look into 22 and beyond. What the heck does that mean in layman's terms, Saj? And it's like, hey, we had $700 million in capital related to growth, right? So then the next thing he says is $350 million of that capex that is going to drive top line and bottom line. So remember those two things. What did he say before that? The dollar for dollar is a good rule of thumb. Literally what I've been saying that this entire episode. Dollar of revenue for every dollar of capex on growth, right? And he's saying that is going to be about 20% that you're going to see that impact on EBITDA margins. That's crazy. And the CEO also chimed in. This is what gives me so much conviction in this company. Every capital investment that we make, we tie it to an anchor customer, ultimately to help us pull through in the success of those investments. And there's a lot of confidence in this strategy that we have deployed over the last several years and are continuing that forward in each of our four businesses, all with its own unique value proposition, creating the kind of diversity in our portfolio that gives us resiliency regardless of the economic environment. Literally, the CEO just said that. I think that gives me so much confidence in Berry Global. Great company. Again, full disclosure, don't own any shares in it. And when and if I do, I'll disclose it, update the description that I'm very long this company. But again, that is my analysis and thoughts on Berry Global. Hope you guys enjoyed it. I know for a fact that I'm going to try to make these episodes much, much tighter. I think 20 minutes is a good, not that trust me, I could talk forever, but I'm going to try to do a little bit more succinct in some of my points. Unless people like me kind of diving into every possible little detail, I could talk about this stuff for hours, but I'll try to be mindful. I think 40 minutes is a good way to digest some of the analysis that I've done. And again, if people are interested, literally how you do this is read the prospectus, read the company section, business, strength, strategy, summary financial results, risk factors, read the latest Q or K, investor deck, read earnings calls and transcripts, And that's ultimately how you get to this, and then kind of make your own model, do your own valuation, do your own comps analysis, and that's how you get to it. But anyway, guys, episode 2, Finance Musings, in the books. Really excited, and I will see you guys all for next week, and excited to see what company I choose to analyze and break out and talk to you guys about. Anyway, all right, guys, take care and have a good